That said, quickly I'm going to mark the equity market reaction because we went in absolutely flat into the policy, and flat is how we continue to be. We're at 17,700, haven't budged from there. The broader markets, though, are much more livelier, as has been the case the past many trading sessions. Chola Finance, Bandhan Bank, Grasim, Godrej Consumer, Polycab, these are the names which are holding up. Within the Nifty, it's not really financials, but an SBI Life, Coal India, UPL, Adani Ports, JSW Steel. It's a bunch of these names which are actually continuing to hold out. Cipla, HDFC, Sun Pharma, TechM, HDFC Bank, TCS, they continue to be in the red. Mythili, I don't know whether to give you that 1 point and me nil or vice versa, while I still await clarity on what's been done on the reverse repo. But your first take, Mythili.
Well, actually, Aisha, I'm actually pleasantly surprised because they've begun the normalization process. It might be too small, baby steps, etc. One can argue about whether more needs to be done, but at least they've begun. So that, to my mind, is good news because to my understanding, the reverse repo rate remains unchanged, but they now have an SDF, where as a result of which the corridor comes down to 50 basis points, which is what it was pre-COVID. And mind you, the SDF is without collateral. So banks will have greater freedom to put money under the SDF. So that, I think, is a good thing. Also, the tone of the governor's statement was much less, what should I say, forceful. It was much more nuanced. Because unlike earlier when he used to say that we will remain accommodative as long as it is necessary, I'm quoting, to revive and sustain growth on a durable basis and continue to mitigate the impact of COVID, etc., etc. What did all this mean? Revive, sustain growth, durable basis, all this was actually, it was completely bizarre because these are terms which are very subjective. Whereas now he has just said, we will ensure that there's enough liquidity. We already have 8 lakh crores today as on date. Of course, the revision in growth estimates, inflation estimates was expected. The only thing is that the growth estimate has been revised on much less than the inflation estimate, which has been hiked up by much more. So logically, you would have expected a little stronger action really as far as the RBI is concerned on the liquidity front. But as I said, given the fact that nobody expected the RBI to do anything, given its past track record, this is a welcome beginning of a change. And hopefully it will go forward because we've reached the end of the tether as far as monetary policy is concerned. Now, as far as growth and monetary policy is concerned, so now the focus has to shift to price control. So I'm happy to see that, no complaints at the moment. More, yes, but how much more can one ask for from an RBI which has remained, absurdly status quo all along?
Okay, Mythili, so that's the first take coming in. Nilesh, come in. What do you make of the policy statement? Is this something that the market wanted to hear?
Undoubtedly, this is what market wanted to hear. To start in a lighter vein, RBI governor talked about faith. Faith moves the mountain, and market will keep faith in RBI's ability to manage current situation. Undoubtedly, this is the policy where they have kind of started the normalization process. Liquidity will be adequate, but not excess. Monetary policy will be less accommodative. And hopefully with STF, the reverse repo and repo rate corridor, even though it is maintained, will probably result into operating rate moving towards repo rate. So in all, it's a policy which will give confidence to the market to keep the faith on RBI.
And Abheek, what do you make of the assumption that RBI governor has taken on crude at $100 per barrel? Do you think on account of that is the reason we are seeing the CPI estimate all the way to 5.7? Because the street was expecting anywhere around 5.4, 5.5.
Is that for me?
Yes, Abheek, that's for you.
Yes, I presume so. We had a number of 5.7%. It's all very dynamic. It depends on where you assume crude prices would be going forward. But I think this is the right approach in the sense that you take what I would call a fairly aggressive number for oil prices and hence don't get accused of being too optimistic on your sort of scenario building, and then sort of build in your inflation forecast instead of coming in with a lower inflation forecast and getting criticized for there being too many upside risks to the forecast, which, if you remember, was precisely the case in the last policy when they said 4.5% was going to be the average, and everyone sort of said that, oh, it's way too low. So I think they have erred on the side of caution, and that I think is sensible policy making, forecasting in this kind of a situation. So you sort of build in the worst case. 100, I think, is pretty much at the sort of the right tail of the price distribution, unless something really crazy happens in the geopolitical situation or in oil supply.
Ashwini Tewari of State Bank of India, Managing Director of State Bank of India. Ashwini, what is your first take on the policy? Are you happy? What does this mean for deposit rates? If deposit rates go up as they are likely to, will you again have more liquidity in your hands than you really care to keep? Ashwini?
Yeah, so first of all, as we have seen over several policies over the last couple of years, the RBI is their own, they have their own views. They don't necessarily get guided by what the markets are expecting or what the analysts are telling them. And this we have seen. So there is this withdrawal of accommodation which is starting, and the government made it clear this will be a multi-year affair. It is not going to be 1 or 2 quarters. As far as the deposit rates go, we have been increasing deposit rates in different maturities. It's not that we have not, because we are responding to the depositors' ask, the growth in the system, and the various categories in which we have deposits and where we want to have growth. So we have been doing this, and in response to this withdrawal, and if the overall rates go up, I mean, today is still very early, we will surely look to increase rates if they are warranted. We are also seeing credit growth happening now in the last quarter, especially capacity utilization going up. So I think this policy is in tune with all these data points separately from the banks and from the market at large. And it is responding to this. We are also happy with the HTM announcement, which was expected, but till it is made, we can't talk about it. So now that it has been made, and in fact it has been made 23%, will give us a lot of headroom to actually prevent against the provisions and also buy up more securities if needed.
Nilesh, I must confess I'm being a little naughty here, but I cannot resist asking you this question, taking off from what Ashwini said. He said it's very evident that the RBI is guided by its own views and does not get influenced by the market. So does it mean, Nilesh, that you guys are not doing your job? Nilesh?
I know, Mythili, you have been targeting us, but on a serious note, market is actually pricing in a lot more actions by RBI. And probably that is the reason why RBI would like to discount the market right now. If we see the spread between 10-year minus overnight or 10-year minus 1 year, it is almost discounting 1% to 1.25% hike in repo rate. Now, whether that happens or not, who knows? It will all depend upon data. So probably RBI is now trying to anchor the market rather than market leading the RBI.
Nilesh's banter together has been infamous, right? Mythili, good cop, bad cop kind of roles both of them have been playing.
No, I said, Ashwini gave me such a beautiful opening that I couldn't resist it, and Nilesh is there with us. So, and obviously, you get a loose ball and you have to hit.
He's the yang to your yin, Mythili. Nilesh.
Absolutely.
No, go ahead. You had a question for Mr. Kumar, I guess.
I just was asking him, that what is your view on how rates will move? Because I think the 10-year yield has already gone up to 7%. Remember, there was a time not so long ago when the RBI used to get very het up when rates crossed even 6%. So what does that mean? Is the RBI comfortable with 7? And what does that mean for the entire policy stance? If your 10-year is at 7, what is the point of keeping your repo at 4? Mr. Kumar.
So is this for me?
Yes.
Oh, sorry. So yes, the rates actually have been fluctuating a little bit. The 10-year, as you know, if we talk about September policy, which probably Mythili is alluding to, this was around 6% or thereabouts, and we were saying that is the RBI comfortable in that, and does it want a little bit more than that? In this period, it is already comfortable with 6.7, 6.8. That number we've been seeing for some time now. So if it is now 7%, I'm not sure whether RBI is comfortable with that, because there have been auctions where the RBI has not taken above 6.9%. So we will see what the RBI stance is. The rates are very close to 7. So whether the difference between the repo at 4 and the 10-year at 7 stresses the RBI, I have no idea at this point of time. But my sense is that 6.8 to 6.9 is something which RBI has been accepting for some time.
Abhi, can I ask you this question, that if the RBI is expecting and accepting 6.97%, will the government accept it? Because given the fact that interest payments are a huge part of the government's revenue and on the expenditure side, both sides really, will the government be happy, or will the government tell, turn the screws on the RBI and say, look, buddy, where's your support? We had it all these years. Now why are you deserting us? Abhi?
Yeah, Mythili, I think you are sort of delving too much into what is euphemistically referred to as political economy issues. I am not going to comment on it. It is difficult for the government to be happy with a 6.9 or 7% yield given the size of the borrowing program. But I would like to believe, and you may well disagree with me, that the RBI is an independent entity. There is, communication and coordination with the government. But I think the RBI would let bond yields prevail at levels that are compatible with macroeconomic fundamentals. And these include external influences. The US bond yield has gone up so much. So that's where I'd like to let it rest and not get into issues of pressure from North Block on Mint Street, etc.
Abheek, I agree with you because, journalists have the luxury of being able to comment on anything and everything without having to worry too much about whether you're stepping on people's toes. So I completely accept that. Political economy is at what most, bankers, etc. would like to steer clear of. That's a luxury that people like us have, so I'm accepting that. But Nilesh, we're going to see the Fed meet in May. And what we're hearing from the Fed governors is that the Fed is likely to hike rates by 50 basis points and also start the winding up of their balance sheet much faster than earlier. Does that change things as far as RBI's today's estimates are concerned on the macroeconomic scenario, in terms of inflation, in terms of growth, in terms of rate estimates? Nilesh?
Undoubtedly, Mythili, I am sure RBI's today's decision would have taken into account potential Fed action. I think Fed rate getting raised by 0.5% and going to neutral rate of anywhere between 2.5 to 2.75 was well discounted in the US as well as global market. The surprise element from the Fed minutes was $95 billion withdrawal on a monthly basis. That's almost $1 trillion of liquidity withdrawal. And that kind of liquidity withdrawal is likely to have impact on asset prices, is likely to have impact on global growth. And I'm sure RBI will keep a watch on the actions of US Fed to take that into consideration for their decision making.
I do hope you're right on that, and Nilesh, I suppose there would be, because if people like us are, cognizant of that, the Reserve Bank of India, with much greater wisdom, would have taken that into account. But Ashwini, for the last question, can I just ask you that what do you think the impact will be on housing loan offtake as a result of this? The real estate sector is already almost quote unquote on fire, but we're seeing only individual housing loans go up. We're not seeing much corporate demand as yet. How much increase do you anticipate in housing loan offtake in State Bank of India?
So the housing loan product and the housing loan segment has been doing very well in the last couple of years. That hasn't seen much reduction. And in fact, in the recent couple of quarters, it has even grown up further. You are seeing all the announcements by builders across the country actually launching new projects or completing new projects. And here State Bank of India, through the Swami Fund, through SBI Ventures, has been playing a very important role as well in completing some of those stuck projects. So I don't think the housing sector is going to show any moderation. It is going to go up further because there is a lot of pent-up demand in any case in the housing industry. Affordable housing is another segment which has been doing well, and we expect more growth in that area. So therefore, on the housing loan side, we remain very bullish. That has been one of our lead products which has done very well in the last several years, including the COVID period. So we expect that to continue.
Yeah, thank you so much, Ashwini, for joining us. I know you have to go, so we will let you go, albeit very reluctantly. But thank you so much, Nilesh and Abheek, for staying on with us. And Nilesh, if I can ask you, what do you think the impact of this HTM relaxation would be? Will banks really be willing to take on more government bonds as a result, Nilesh?
So this will be just one small catalyst, not necessarily the only catalyst for banks to invest into government securities. In some sense, this is the conundrum where we have between 8 to 10 lakh crore of liquidity in banking system, and yet the 10-year government securities are touching 7%. Market is happy, primarily driven by banks to park money in overnight at 375.4, but not willing to buy 10-year paper at 7%. Now, one of the reasons why probably banks are less enthusiastic to buy government securities is mark-to-market volatility, which has bearing on their capital adequacy. HTM relaxation will help banks to absorb mark-to-market volatility and may open up the risk appetite. But as I mentioned, this is one of the catalysts, not the only catalyst. Market will be now looking forward to the passage of borrowing program and RBI's participation in the same. The net borrowing program at 11 lakh crore plus is a humongous size. It's reasonably up compared to last year. And there was a hope in the market that since the government had kind of underestimated revenue, there is a potential that the first half borrowing program could be a little lesser. But RBI has given first half borrowing program at about 59% of total borrowing program. So we'll require multiple catalysts for banks to become enthusiastic about buying of government securities. HTM relaxation is one small step, but more steps will be required.
Okay, Nilesh, so that's the word coming in. Let's take a quick look at the market as well. The Nifty is holding on to that 17,667 mark. A jump of around 30 points is what we have seen. But we're pretty much toying around that flat line when it comes to the index. Nifty Bank had just around that policy statement time. We had seen a spurt of around 100 points on that index. But now that has also flattened out. In fact, it's only the mid-cap index which is showing good strength because that index has gained around 0.7%. And you can see the top gainers as far as the Nifty goes. They're largely the commodity names which are still holding up in the green. Abheek, I wanted to come to you. Rather, let me stay with Mythili and discuss this. Mythili, what does this do to the forecast going forward in terms of the expectations of what will happen to the rate hikes? Will it now come in the month of June, or is it something that we should expect in August only, and in June maybe we'll see a stance change come by?
Well, I think effectively, even though they've not said there's a change in stance, in so many words, what is interesting, number one, is that Jayant Verma, who in fact earlier objected to the continuance of the accommodative stance and said he wanted to shift towards neutral, this time the decision to stay on an accommodative stance is unanimous. That means Jayant is now happy with the introduction of the MSF. So that's one clear indication that the RBI and the MPC rather feel that they have done enough to indicate a change in stance, not in so many words, but there's an unstated change in the stance, as it were. At the same time, the statement is much more dovish than one would have expected, given the fact that there's been a dramatic change in the environment. So one will have to wait and see what happens, because the governor was also very emphatic that the excess liquidity, which continues to be 8 lakh crores, mind you, he says it will be withdrawn over a multi-year time frame. This is at the time when the Fed is accelerating its winding down, and the RBI says we're going to give you a multi-year time frame. So there are these disconnects between what the Fed is doing and what RBI is doing, and the fact that inflation in the in the US is very different from inflation in India, because there it is driven by wage price hikes, and India it's not. That's a very unfair comparison, because India is a labor surplus economy. Here labor doesn't have a choice. You will seldom find wage inflation happening in India the way it happens in the US. We are a labor surplus economy, and to say that just because there is no wage hike, so we can take the labor as it for granted and hence allow higher inflation, I think it's a little unfair to the common man, because here what you need to worry about is about food inflation, fuel inflation, both of which are very high. So there's a disconnect between India and the US, not only in terms of inflation, but also in terms of policy action. So we'll have to see what the RBI sees in June, whether government is happy with interest rates going up to perhaps 7 plus. What does it mean for government borrowing? Because RBI has so far been a very good boy, quote unquote, and allowed government, borrowing to happen. Now this raises question marks on our government's large borrowing program for H1. So I would not like to stick my neck out and say what is going to happen in June. Let's see how things pan out, and then we can take a call perhaps.
Okay, fair point. Mythili, stay with us, but Abheek as well as Nilesh, great to have you both on the show. Thanks for taking time out and analyzing the policy takeaways as always with us.